Shen 呢，他是international financial speaker，也就是 trader and investor with over 10 years，就是有10年的这一个经验，在投资本地还有外国的股票、ETF 还有这一个 currency 的。Alright， 他本身呢，他开始投资是 back in 2008年那一时候 financial crisis， 2008年呢，他看到了那一个机会他开始用他的这一个 student loan， 也就是 PTPTN 呢 invest 在这一个 stock market， 然后他就没有管它了咯。after 这个大概一个 decade， 就是大概一个10年这样子他在装修，他在继续磨练他的这一个投资的这一个skills 呢，他已经是made up to be one of the most sought after educators in the industry and achieve that is true prudent investing， 就是这一个价值投资咯。他本身呢the strong conviction leads him to founding Wealthfort International, dedicated to empowering individuals to achieve sustainable wealth. Wealthfort International 也就是他创办的啦。Alright， 这一位这个讲师呢，他也是 certified professional trainer by 这个 IBMA UK。他 as a speaker 呢，他 engaged by investment banks security firms 来 train 他们的那一个 retail clients 在这个 investment 的方面咯。Alright， 其他这一个 financial institutions such as 这一个 Bursa Malaysia、Singapore Exchange、RHB、Hong Leong、Tenaga、Alliance Bank、M Investment Bank、CGS-CIMB、TS Securities、是在这个 General、eToro 还有其他全部都是他在被他邀请这一位讲师过去的。Alright， 最后2015呢，他也是 appointed by Malaysia's National Stock Exchange、Bursa Malaysia to design and conduct investment curriculum to young investor and retail investor worldwide。他已经被超过20家的大学过去作为这一个这个 investment 方面的讲师。Alright， 他最后呢，他也是一个 regular guest on 这个 TV 还有 radio shows 如果你们本身有听到他在可能 TV 还是 radio 有分享到关于 personal finance、entrepreneurship 创业economy 经济trading investment 这一些他都有分享，他是一个很 great 的 speaker。Alright， 话不多说，我就介绍完了这位嘉宾，我们先把这个嘉宾给欢迎上来。好，就欢迎 Shane。Alright。Hello，
大家下午好。谢谢主持人今天为我做出这么很好的、很棒的一个介绍 ，OK， 所以很开心在网上可以见到大家。但是今天呢，我会是以英文为这个 presentation 的 format， 所以我就允许我用英文所以我现在是可以 share screen 对不对？等一下。OK， 可以看到我 screen 吗？应该可以看到了等一下OK， 好的 OK， 就允许我用英文来呈现今天的一些演说。OK，so a very good afternoon to everybody. So welcome everybody to this Facebook Live brought to you by EE Cameron. And done by me called Value Investing Masterclass. And first of all, before we begin, I just want to thank the team from EE Cameron for inviting me here to be in their Wealth Creation Summit to speak on this topic on value investing, which is 价值投资. Okay, so we are very excited to present this for you. Now, maybe you have heard of value investing, but today we're going to delve deeper into what are value investing and how you can use it to create sustainable wealth for yourself. So for this 1 hour segment, we are going to discover how to achieve 10% to 30% return in the stock market every single year without the risk of losing your hard-earned money, even if you have no financial background. So this is what we are going to do. So who is this live designed for? Designed for new investors. If you are a new investor or whether you are already an existing retail investor, don't worry. It's also designed for anybody who wants to learn about investing. So this session is meant for you. So if you implement the strategies, the ideas that we share about in this session, you are going to be won't be so fearful about the market, but instead you'll be able to build up a skill and a strategy that can allow you to safely compound your money in the stock market year after year. So make sure you watch until the end of this Facebook stream. Now, allow me to briefly introduce myself, because the MC have already introduced me a fair bit, but let me touch on a little bit. Like what the MC has said earlier, I started investing when I was 2008. So I see that there was a crash in the market, and then I took my PTPN loan to go to the market and start to buy stocks on the cheap. And then when I was turning 23 years old, I was already featured on BFM. So that was me when I was 23 years old, going on a show on a business station 89.9. So subsequently, I got invited to several more media to talk about entrepreneurship, market outlook, financial planning, as well as the sectors that we have to watch out for. So here are some of the my media exposure as far as media interviews are concerned. Then professionally, I speak a lot about stock market for investment banks, software companies, charting companies, fintech. Here are some of my programs with Tenaga, TA Securities, Bursa, RHB, Alliance Bank, Hong Leong Bank, M Investment Bank, and so on. So much so that I've done so much work for them that I was even featured on Tenaga Group website on their banner. All right, so if you want to connect with me, you can go to Facebook and find me, Choo7. That's how you can connect with me. On my Facebook page, I share regularly about the webinars that we do and also about the market update. So if you connect with me on Facebook, not only will your financial IQ skyrocket, but will also moon rocket and sun rocket. Okay, so just connect with me on Facebook at Choo7. So without further ado, let me go straight into the topic today, which is value investing. Now, how ordinary people invest in the stock market? Ordinary people always invest in the stock market by listening to tips. Okay, I'm sure you have heard or have seen friends that really invest in the market blindly by hearing their friends say that, now this stock very good, this stock are confirm go up, this stock are confirm make money. Yeah, very familiar or not? So if you heard this phrase, I'm sure you have friends who are stuck there, in some of the companies, because they hear people saying this stock good, that stock good, here tips confirm go up to invest in the stock market, and eventually they lose a substantial amount of their capital or their net worth in the stock market, and then they never believe in the stock market again. So this is what ordinary people invest in stock market, by listening to tips. You know why? Because they lack the financial knowledge. They lack the financial skills to understand a company inside out. That's why they hear their friends for tips. They rely on tips to invest. So this is exactly what we want to discourage you from doing. I'm sure the team from EE Cameron will also have the same principle by sharing with you a relevant case studies. I often read up the articles. Okay, so they also produce a lot of great case studies for you to see. So this is what the financial bloggers and also the stock market professional want to advise people against doing it by following the tips or following the herd. So we need to be able to have independent judgment to know which stocks, to know the company, to see whether it's worth investing or not. So, but if we don't follow the majority, let's look at what are strategies we can use. Now, if you look at these four gentlemen here, can you guess what do these four gentlemen have in common? So they are all multi-millionaire and they are billionaire. Okay, like Warren Buffett, net worth 70 over billion, Christopher Brown 260 million, Peter Lynch 350 million, Seth Klarman 1.6 billion. So if you follow the strategies, which I'm going to review to you shortly, you'll be able to build to the net worth. Okay, if it's just 1% of the net worth, will also be good enough. Okay, so if all these people, gentlemen, can do this, so can we. Okay, we can also duplicate the same strategy and achieve a similar success in the stock market. Okay, so this is what we will attempt to do. Okay, in this Facebook Live, I'm going to share with you 3 secrets. Secret number one is how are we going to compound money safely through investing. So that's secret number 1. Secret number 2 is how to reduce the risk of investing without having to monitor our portfolio day and night. And secret number 3 is how to achieve 1 million ringgit with just a fraction of your income. So this is what we're going to cover in this an hour sharing. So are you ready? Okay, so let's get started. So secret number 1, how to compound money safely through investing. Okay, this is the strategy we're going to talk about, which is value investing. Value investing can help us to achieve this objective, to compound our money safely without having to take excessive risk. So before we talk about value investing, let's first talk about what exactly is investment. So, I have come across many terms, many investment definition, and the best definition that I want to quote from this gentleman. Okay, if you know this gentleman, who this gentleman is, in comment in the Facebook Live. Okay, let me know. Who do you think this gentleman is? Now, if you look at the photo, you know that this is probably not our time, gentlemen. These are the older photo, which probably maybe a century ago. So this guy is none other than Benjamin Graham. Okay, he is the founding father of value investing. He was the man who coined the term value investing. And when Warren Buffett was studying in university, he purposely went to Columbia Business School to learn under this gentleman, okay, which is Benjamin Graham. So he taught Warren Buffett, which is the world's most successful investor, on how to invest in the stock market. So in his book, which is called Securities Analysis, which he wrote it during the Great Depression, 1929 to 1932, Securities Analysis. If you happen to have that book, or if you read the book, you notice that this book the language is pretty dry, okay, because it was written, a century ago, and then the language, even though it's English, and even though I have some financial knowledge, and I also feel that my English is okay, not bad, but when I read the book, it was really, not easy to understand, okay. But nonetheless, there was this paragraph which is very profound, and I quote it from you here. So he actually defined investment in such a manner. He said that an investment operation is one which, upon thorough analysis, promises a safety of principal and an adequate return. Operations not meeting these requirements are speculative. So how many? So there are 3 keywords here. How many? So 3. So what is investment? Investment must have these 3 keywords. Number 1, you must do thorough analysis. Not only you must do an analysis, but you must do a thorough analysis. You must do as deep as you can when you study about company or security. Okay, so nowadays people, when they do investment, they never do analysis. They just hear people say, wow, Topglov can buy, Supermax can buy, so they buy at the peak. Okay, so this is something that people hear people say, right? Then they follow suit. Okay, so you must do thorough analysis to see whether this company is undervalued. Okay, so before we invest in. Okay, so the second criteria is safety of principal. Okay, in whatever investment you do, you must know that you must give you a certain level of safety assurance. So you must know that when the asset classes that you invest in, you must be able to know that your money is safe. That you know what exactly the management is going to do with your money. Okay, unlike when the investment scheme like JJPTR or any other Ponzi scheme, when you park your money there, they give you what guarantee return. Okay, this is exactly where you may not know what they are going to use your money for. Okay, they might actually misuse your money, and then you will actually burn your wealth there. Okay, and the third criteria is adequate return. So because we are not doing charity, we are not doing philanthropic work. So whatever money that we park with, you must be able to assure us to have an adequate return. So if any of these 3 criteria, is not fulfilled, then you may not be able to get you are not actually investing, but you are actually speculating. If you don't do a thorough analysis, you only invest in something that can give you adequate return, then you're not investing, you're speculating. So this is the definition of investment. So these 3 keywords: number 1, you must do a thorough analysis. Number 2, it must assure you a safety of principal, and number 3 is must give you an adequate return. So now we have just talked about investing, right? So let's talk about what is value investing. All right. Now value investing, like the word coin, value means in Chinese means 价值. Okay, that means it is worth to invest. Okay, so now value investing, in short, is a strategy that allow us to buy things on the cheap. Okay, to buy a certain asset below their real value. Okay, so that is the investing strategy. In short, it is a strategy that allows us to buy 1 ringgit worth of stock at 50 cents. Okay, would you lose money in the long run if you know that your asset you bought is 1 ringgit worth, but you actually bought it at 50 cents? Chances are not so great, right? I mean, in the long run, you will be able to still make money. Okay, so in a diagram format, we want to look for a stock whereby the value keep going up, but then the price keep going down. Okay, when there's this value and price divergence, we call it we go in and do value investing. So now the question is, Shane, how to find company like this? Value go up, share price go down. Possible, meh? Okay, possible or not? Actually, in a normal inflationary market, it may not be so easy for you to spot one. But in a recessionary period, whereby the market are very emotional, they sell everything that they hold on just to exchange with cash, then we might see all this kind of market irrational. Okay, then this value price divergence will be more apparent and it's easier to spot. So right now it is very critical because we are now in my opinion, they are also we are living in a very volatile market right now because the pandemic has really changed the operating landscape. So there are stocks that are of course overvalued, and there are also stocks that are actually undervalued, at trade below their book value. So what we need to do is to be able to develop the skill, the mindset and knowledge to be able to spot this. Now, is value investing very hard to learn? Obviously not. Okay, we all are born with this intrinsic skill. So what do I say? So now, just imagine value investing is like when you go to the supermarket and you want to buy stuff. Okay, you go to the supermarket if you really love a pair of shoes that you really like. Okay, so yesterday you saw that they were selling for maybe 300 ringgit, and today you went to the same mall and you find that this pair of shoes were going for discount. Okay, they are only selling for 150 ringgit, and you really love them. Would you buy? You will buy, right? Because yesterday they were 300 ringgit and today they are only 150 ringgit. So you will buy, right? So the same goes to the stock market. You see, yesterday share price is 3 ringgit. Let's say today 150. Okay, you buy or not? Most people they won't buy. You know why? Because they see the price crash so much, they sell. Okay, so when we go to the stock market, we must embrace the kind of strategy that we use in the shopping mall. Okay, we must go there and find good bargain. Okay, like how we buy shoe. If yesterday the price is 3 ringgit, today 150, and it's a good stock, then of course we buy lah. So it's not like when you go to the shopping mall, you see yesterday the price 300, today 450, you buy. No, right? You want to wait for discount, right? So in the stock market, we also want to wait for discount. So this is also when we need to have the kind of patience. Okay, wait for Hari Raya sale. Okay, so from normal time, inflationary time, you can see that maybe out of the 900 counters, maybe there are a few counters that offer a 10% discount, 15% discount. Okay, in a recessionary period or bear market, then we can see that it's like the shopping mall having Hari Raya sale, Christmas sale. Okay, 90% of the store are having 50% discount. Okay, so this is a time where we need to be more aggressive. Okay, like what Warren Buffett said: buy when people are fearful, sell when people are greedy. So this is value investing. We want to buy when the price go down, when the market become irrational. Price go down, but the values remain no change. Then when there's this price value divergence, that's where we go in. Now, in value investing, what we need to do is we need to search for undervalued companies. Okay. Now, value investing is not a skill to buy cheap stocks. Okay, remember, cheap stock can go cheaper. So we don't want to buy into cheap stock. We want to buy undervalued stocks. Okay, which is undervalued companies. So what are the characteristics of value investor? Number one, we select stocks based on value. So the thing is, people always the number one grave mistake that retail investor make is they select stock based on the price. So why they say, wow, Nestle 140 ringgit, expensive oh. Walao. Okay, but what if I tell you Nestle, intrinsic value is 180 ringgit? Is it expensive? Not so, right? Because the value is 180, now trading at 140. Okay, for example, now what people do is they say, wow, this stock 10 cent only. They like penny stock, wow, very cheap. But what if cheap stock can go cheaper? So what if the cheap stock, right, is selling at 10 cent, but the real value is maybe it's only 2 cent? Okay, do you actually buy cheap or buy expensive? Buy expensive, right? So that's why value investor, the first thing we study about a company is not to look at the price. Price is the last thing that we see. The first thing we see is the company's business. Okay, whether this company got value or not. Okay. Then secondly is search for companies whose price is below their value. We must know okay, what is now, because good asset may not means that it is good investment. Okay, we must wait until the asset is worth investing in. Okay, so we must have patience. So we focus on the company and its business. Okay, the value investor, focus on the company and business. In the market, there are actually two markets. Okay, number one, we have the stock market. Stock market is where the traders focus their attention on. Okay, every day they look at the charts, they see the stock market. Okay, well, this stock high volume, this stock top active. Okay, so this is the counter that they are going to focus on. But for investor, right, if we won't really focus on the stock market. Okay, what investors should do is to focus on the real market. Okay, so this is the second market, the real market. If you invest in Nestle, we must always see, okay, observe, are people eating more, consuming more Nestle products? Okay, are people drinking more Milo? Are people buying more Maggi mee? Okay, for this MCO? Okay, so if you are a trader, you focus on Nestle price. Okay, or you focus, if you trade Starbucks, you focus on Starbucks price. If you're an investor, you focus on Starbucks business. You want to see whether are there more people drinking Starbucks or not. So this is the idea. So what you need as a value investor, okay, number one, you need simple mathematical literacy. Okay, you need to know how to do plus, minus, multiply, and divide. Okay, so long that you know these four, right, then okay, you can fulfill the first criteria to be a value investor. Do you need to have an accounting degree? The answer is you don't. You don't need to have an accounting degree. You only need to have simple mathematical literacy. Okay, if you don't know how to do plus, minus, multiply, and divide, then stay away from the stock market. Okay, it's very dangerous for you. Number two, common sense. Do you have common sense? Okay, ask yourself, do you have common sense? Now, for me, of course, yes lah. I believe you too have common sense. Okay, so if you have common sense, then you'll be able to fulfill the second criteria. Okay, so the third criteria is you must have basic fundamental analysis knowledge. So, which is follow more on the pages. Okay, that we that talk about stock market, then you'll be able to improve financial intelligence. So, and ultimately what you need is time and patience. Okay, time and patience. 要有时间还有耐心. Okay, so as a value investor, we must have time and patience. You must be able to wait. And this is exactly even though I talk about value investing and some people still ask me, hey, why I buy today then tomorrow never go up? Okay, so as an investor, we don't expect the share price to go up tomorrow So we want to buy into the stock when the price is attractive. We buy and then wait, for it to appreciate. Because in the long run, the true value of the company will be reflected on the share price. Okay? In the short term, the market is like a voting machine, okay, to see which buyers more, or whether there are more buyer, more seller. But in the long run, the market is a weighing machine. Only the stock with a true weight will stand out. Okay, the market will realize the value, and then the real value will be reflected on the share price. That's on the long run. Now, in value investing, you actually don't need complicated charting, so which is incredible. You don't have to learn a lot of complicated charts. Now let's take a look at this case study Tenaga. Okay, I use a big cap stock. Okay, I use a big cap stock to illustrate to you the the company that is quite big. Now You see, if you look at this company, Tenaga, you may say, oh yeah, not exciting lah. Okay, I want exciting one. Okay, Enix is exciting. Okay, but it's very dangerous, right? Speculative, right? So in investing, you don't want excitement one. Okay, investing is supposed to be as boring as you can. You want excitement, right? You go Genting, Malaysia. Okay, you go there, gamble. Okay, that one is exciting. Okay, in stock market, if you're having fun, right, you're actually not investing, you're speculating. Okay, so let's talk about this case study. Okay, Tenaga. Now, back when I first started investing, which is 2008, so the Tenaga was trading at 3 ringgit and 85 cents. Okay, it was trading at 3 ringgit and 50 cents, and then we noticed that because that time if you are knowledgeable or you were old enough, okay, at 2008 I was already in university already. So if you're old enough, you know that 2008 was actually the subprime mortgage crisis that happened in America. Okay, at that time I studied actuarial science, and in my class, my teacher also talked about financial derivative. Okay, and used a lot of case studies that happened in America. So I learned about financial derivative. I also passed papers on the financial derivative. So when 2008, right, we noticed that Tenaga net tangible asset per share. What is net tangible asset per share? NTA. Net tangible asset per share means that if you take all the tangible asset, you take all asset minus the liability minus all intangible asset, whatever tangible remaining, these are all net tangible asset. So it's about 6 over ringgit. So Tenaga net tangible asset is 6 over ringgit. So Tenaga as a utility company is a very asset driven company. I need asset to churn out electricity for you. So asset worth is 6 over ringgit. But what was the price? 3 ringgit 85 cents. Okay, they trade below the net tangible asset per share. In other words, if Tenaga at that time, right, decided that, okay, I think I got very tired about this supplying electricity to Malaysians already, I want to sell my business. If Tenaga sell all their asset, pay back all the liability, right, each shareholder can take back 6 over ringgit. And then the share price, the share market is now trading at 3 ringgit 85 cents. So tell me, is it undervalued or not? Obviously undervalued, right? So because if Tenaga decide not to do business, sell all the asset, pay back all liability, right, every shareholder can take back 6 over ringgit, and the price is only 3 ringgit 85 cents. Can you resist that? So if you buy in December 2008, 3 ringgit 85 cents, you hold it until June 2018. Now this was the time where Tenaga, the performance start to slow, they start to decline. So when the performance start to decline, right, then you sell. So from this 10 years period, what is your capital gain? 274%, compound annual growth rate is 14.9% a year. So total dividend you receive it 13 times, dividend yield is 59%, so your absolute gain is about 16.68% a year. Now this is of course a boring stock, which may find Tenaga a bit boring. But if you look for stability, if you buy that time undervalue, this is can still use for about 16.68% a year by buying into a really solid company. Okay, at that time subprime mortgage crisis turned the market downward. So a lot of people out of fear sell all the good asset down. So Tenaga was actually traded at 3 ringgit 85 cents. You ask me, does Tenaga have anything to do with subprime mortgage crisis in America? Answer is no, right? It's not like they are lending out a lot of toxic derivative to the Malaysians or to the worldwide investor. They don't, right? So they are not involved. They also don't have properties in the US. So why do the share price down? Because when the market is irrational, when the market is fearful, everybody sells. So when there's this price and value divergence, we go in. That's where we can buy good company like Tenaga at a cheap. It's not only Tenaga, buy into all great assets. Okay, Maybank, okay, public bank, okay, those days, right, that crashed to a record low. So not to mention that you have a bonus issue 4 for 1. For every 4 share you get a 1 share free. Okay, now let's take into another case study, Magni. So I use a big cap to tell you about a big cap stock, which is Tenaga. Let's talk about small cap. Okay, I think many of you would like a smaller cap company, which is for example is Magni. Okay, now Magni, if you are that time in 2013 when I started to observe about this company, I noticed that Magni had about double-digit profit growth. Okay, double-digit profit growth. PE only 6. And then the price to book value, the book value is about 1 ringgit 91 cent, if I'm not mistaken. 1 ringgit 91 cent back in 2013. What is the share price? 1 ringgit and 5 cent. Also trade below the book value. Okay, the Magni, if you don't know what they do, they are actually a apparel manufacturer. Okay, 90% of the business is apparel manufacturing. So they manufacture apparel for this brand called Nike. Okay, I'm sure you heard of this Nike brand, right? So they export to Nike, to Nike, to export. So at that time, book value is 1 ringgit 91 cent, share price is 1 ringgit and 5 cent. Double-digit profit growth, low debt, and then good liquidity. Okay, everything good. Of course, Magni has one risk, which is key customer concentration risk. So, but then the valuation is very attractive. It's only 6. So if you buy into it, which is trade below the book value, 1 ringgit and 5 cent, and hold until June 2018. So we made about how many percent return? Okay, capital gain is 423% return. Compound annual growth rate for this 5 years period is about 39% a year. So total dividend you receive is 13 times. Dividend yield alone is 64% already. Okay, so your absolute return is about 500% in 5 years. Okay, isn't that incredible? So this is power of small cap. Okay, small cap can multiply even bigger. Okay, even faster than the blue chip like Tenaga. So I given you 2 case studies, both of which are undervalue purchase. Of course, we still have more, but due to time constraint, just share with you 2. Okay, now at the moment, as of speaking, Magni is still trading at single digit PE ratio, about 8. But that doesn't mean any buy or sell signal. All right, so I just talk to you about value investing. Value investing is essentially a skill for you to buy a stock for 1 ringgit worth of stock by 50 cent. By benchmarking, the first thing is know what's the value of the company. So that is value investing. So I'm going to go to the secret number 2, which is how to reduce the risk of investing without having to monitor your portfolio day and night. So are you ready? Okay. The secret is you buy a good fundamental company. Now, why do I say so? Okay, if you take a look at this image, which is even a mice who want to eat the cheese also need to wear the helmet, right? So this is risk management. Now, may I ask you this? When you go across the road, is there a risk or not? I'm sure there's risk, right? Okay. If you blindly go across the road, if you fool yourself, fool your eyes, you go across the road, will you have risk? Definitely have risk, right? If you unfold yourself, if you look to the left, okay, you only look to the left, you go across the road, will you be hit by a car coming from the right? Yes, right? If you only look to the right, you go across the road, you may be hit by the car coming from the left. So what if you look left, look right, see no car, you go in front, right? Maybe there's still a pothole and you fall into that. So if you look left, look right, look into the ground, okay, no pothole, you go across, maybe there's some bastard who throw a flower pot, okay, on top, that hit you on the head. So there's also a risk, right? Can you say that there's a risk? So you don't want to cross the road, you don't want to go out. You can't, right? So it's same like driving a car. Is there a risk when you go drive a car on the road? Yes, right? But can you say because there this accident risk, I don't want to drive? You also can't, right? You can't say you don't want to go out, because in everything that we do, there's a risk. Okay, so what we need to do is learn to manage our risk well. So how do we reduce the risk in the stock market? We must buy into good fundamental company that can allow you to sleep soundly at night. Okay, because the last thing you want to do when you go into the stock market is you are emotionally stressed. Okay, you buy into speculative stocks and then you don't know the performance of the company, and you don't know where you can't reasonably forecast the company profits. Then you also don't know the performance, so you actually cause you financial emotional distress at night. This is the last thing you want to do when it comes to stock market investing. So, and then a lot of people say that stock market is very dangerous. I'm sure you heard of people saying that stock market are very volatile. Now, true enough, I have, I've been talking about stock stock investment for quite a while. Okay, and then I also have many friends who are in property investment, and they tell me stock market no lah, stock market I won't go into that. But recently there are a handful of the stock market property investor who actually go to the stock, who also come to join the stock market as well. So when people talk about stock market, they generally think that it is dangerous. So let's compare why people prefer property than stock. Now people like property because it says that steady appreciation. Okay. Number two, safer. Number three, it gives us rental income. Okay. Number four, you can flip. Okay, when when you appreciate. In stock market investing, people say that sometimes go up, sometimes go down. Okay, unlike a property, most of the time is go all the way up. Number two is dangerous, volatile. Okay, speculate. People like to speculate in the market. So these are characteristics of a stock investing. But is it really true? Okay. Now, if you use the right strategy, it may not be like that. Okay, let's look at the property investment. Usually, when we invest in property, what is the three main criteria? Criteria one is must have good location. Right? What's the criteria number two? Good location. What's the criteria number three? I guess you know this, which is good location. Okay, location. So it must be in the right location. Okay, so criteria property investment, must be in good location. Okay, number two, high occupancy rate. You will look for property whereby it has high occupancy rate, whereby once it becomes vacant, right, it's very easy for you to find tenants. Number three is high rental yield. Okay, you must give you high rental yield so that you can have passive income. Cha-ching, right? Number four is below market value. You want to buy below market value and also below bank value. That's what property investors look for. Okay, these are the generally four main criteria. Okay. A grade A location, high occupancy rate, high rental yield, below market value. Now, can stock investing become as safe as property investment? No, definitely. So long that we follow this criteria. What is good location? Good location is not similar to good business model. You must invest in companies whereby they show good business model. Okay, the business keep making money. Number two, high sales turnover. Okay, high occupancy rate could be equivalent to high sales turnover. Okay, got sales. Okay, create a lot of sales. Number three, give you high dividend yield. Okay, so this is similar to high rental yield. Okay, number four is below its value. The share price now is below its value. So if we follow all these four criteria, okay, in stock investing, then the stock investing can be as safe as property investing. Okay, it can be as safe as property investing. Okay, so then when we follow all these criteria, good business model, high sales turnover, high sales turnover would likely to become a high profit, high profit. Okay, high dividend yield and also below its value. Okay, so when we follow this, right, then we will have a steady appreciation. Stock investing become very safe. You can have dividend income. Then you can also have a capital gain. So when we follow exactly the strategy we use to invest in property, we use the similar strategy in the stock market, then the stock market can also deliver you a steady appreciation. Okay, now what are the great company characteristics? How do we find great companies? Okay, number one, great company must have a consistent profit growth. It must give you consistent profit growth. Not only the company need to be profitable, the company also need to give you consistent profit growth. Now, for example, first year the company make 100 million profit. Second year they make 80 million profit. Third year they make 60 million profit. Last year they make 20 million profit. Is this company profitable? The answer is yes, right? But is the profit consistent? Is there a growth? The answer is no, right? Because every year the profit decline. Do you want to buy into a company where the profit decline? The answer is no. You don't want to buy into a company where the profit decline. Okay, you want to buy into a company whereby the profit grow every single year. Like first year they make 20 million, next year they make 40 million, next year they make 60 million, the last year they make 100 million. So this is a company that we want to invest in. Every year they make more and more profit. Number two, the company must have little debt. Okay, can the company have debt? The answer is yes. The company can have debt. Can they have a lot of debt? I want to be more conservative. I don't like company where they have a lot of debt. Okay, I want them to have conservative debt financing. Okay, 不要有太多债务的 ，OK， 是可以有债，但是不可以有太多债务 ，OK， so this is the one thing that we want to talk about, okay. Now because when huge debt, right, during a bad financial time, right, then they will become very strained financially. Number 3 is strong cash flow. Okay, the company must have strong enough cash flow, because strong cash flow, cash is like a bloodline to any business. Okay, no cash, that means the company will go insolvent. So if you can have a lot of debt, but so long that your cash flow is still stable, right, then the company won't go bankrupt. Okay, so cash flow is very important. Number 4 is increasingly more dividend. Okay, you want to find into company whereby they give you more and more dividend every single year. Okay, so this is the characteristic of great companies. Does that take a rocket science to understand this? Absolutely no, huh? So anybody with common sense, right, will understand that this is a characteristic of great investors. So long that you invest based on these 4 criteria, okay, consistent profit growth, little debt, strong cash flow, increasingly more dividend, and you buy them when they are cheap, right? Wow, fantastic! You won't go wrong anywhere. Okay, now finding a great company is similar like how you find boyfriend girlfriend, right? So would you want to find a boyfriend or girlfriend that makes more and more profit, more and more money every single year? Yes or no? I'm sure you would say, most of you would say yes, right? Would you want a company, your spouse, your boyfriend, girlfriend, or husband, wife to have a lot of that? No, right? Just imagine one day when your wife come back and say, "Oh, darling, I just got 2 million credit card debt." Or you stress or not? Stress, right? Okay, so cannot have too much debt. Okay, number 3 is strong cash flow. It's like, oh, you don't tell your darling, okay, darling, I want to buy this handbag. Your darling say, no problem. Okay, got cash. Okay, got cash. So this is strong cash flow. And number 4 is give you more dividend. It's like every month would you want your darling to give you more and more allowance every month, right? Okay, this month give you 500, next month give you 600, following month give you 700. You want that, right? So this is dividend. Okay. So see, finding great company is like how you find a boyfriend, girlfriend. Same common sense. Okay. Now, of course, I'm joking about finding girlfriend, boyfriend, your spouse. Finding your spouse should be an emotional decision. Okay. It's not supposed to be a logical monetary decision. Okay. It's just joking to make it more relatable to you. Okay. So finding great company may not take rocket science. It just take like common sense for you to be able to find out great companies. Now let's do a few more case studies. Now, let's look at this company, Nestle. Okay, just now we talked about this company a fair bit. Now, I purposely take out 20 years data. So this is Nestle for the past 20 years. Okay, since the beginning of the of this 2000 millennium. Okay, if you buy in the first trading day in January 2nd, 2000, and trade until the last trading day, 31st of December 2019. 11 ringgit 90 cent to 147 ringgit 0.1 cent. Okay, 0.10 cent. Okay, do you make money? Obviously you do, right? So why I pull so long data for you? Because I want to show you that if you buy into a great company, hold it long enough, you will definitely make money in the long run. All right. So what is the capital gain? Capital gain in this 20 years period. In 20 years, I'm sure you have seen many bubble already. In this 20 years, what bubble we've seen? Dot-com bubble, subprime bubble, okay, the European debt crisis, okay, and then we have an oil crisis, then we have a pandemic, okay. Does it still go up? It still go up, right? So subprime mortgage. So in this, you see, great company can withstand this kind of recessionary period, okay, and then still emerge stronger. If you buy the Nestle for the past 20 years, your capital gain is 1,136%, compound annual growth rate 13.4% a year. Total dividend you receive is 26 times, total up to 22 ringgit 96 cent. So your dividend yield alone is already 193%. You see, your dividend you receive is almost 23 ringgit, your cost is only about 12 ringgit. Okay, so your dividend alone already cover your cost of investment. Your absolute return is 1,329%. Okay, in 2008 they crashed 15%. In 2020, it crashed about 7%. I benchmark the 7% from the 21st of February, which is before the COVID outbreak happened aggressively in America, and before we changed the government. Okay, I benchmark that kind of price. So case study number 2, public bank. Okay, now public bank, if you buy in January 2000, it's only 2 ringgit 72 cent. Okay, of course I show you 20 years data. If you hold until last trading day in December 2019, okay, 18 ringgit 99 cent. Okay, of course the peak is about 25 ringgit. So you hold until the last trading day in the last year is about 18.99 cents. Do you make money or not? In the long run, you see, if you buy into great asset, you will sure make money. The capital gain is 598%. Compound annual growth rate is 10.2% a year. Total dividend is 32 times. Okay. Dividend yield is 292%. Absolute return is 890%. So this is the second case study, whereby you will see that you have get about more than 10% return a year investing in public bank. Okay, not to mention the dividend yield return. So this is investing in a great asset, and you hold it long enough, you see the price definitely head north in the long run. So second case study is also a big cap stock. Okay, so in 2008, during the subprime mortgage crash, it crashed 33%. In 2020, it's crashed 29%. Okay, right now, public bank is still trading at about 15 over ringgit. So is it worth to buy now? Obviously, I think we can still not to be construed as any buy or sell recommendation, but public bank is still trading above the book value. Okay, I think if you trade below the book value, it's more attractive. The book value is about 11 ringgit. If I'm not mistaken, public bank is about 11 ringgit. So at 15 ringgit, it is still above the book value. So case study. The third case study is a small cap become a bigger, quite bigger. So this is a Padini. Okay, I'm sure you heard, of course I take the case study that you all can relate to, because these are companies that you have heard of or used the product before. So if you talk about Padini in January 2000, it's about 13 cents only. If you hold until the last trading day in 2019, it's 3 ringgit 21 cents. How much is your capital gain? Okay, it's 2,390%. Your compound annual growth rate is 17.44%. Okay, all this we have mentioned just now are all buy and hold. We haven't talked about more advanced strategy when you do value trading. Okay, when they go over value, then you sell. If you can use this strategy to do value trading, then you can make a bit more return. Okay, this is just purely buy and hold. So compound annual growth rate is 17.44% without the dividend. Okay, total dividend you receive is 39 times. Okay, 1 ringgit and 19 cents. Just imagine you put in only 13 cents. And then you take back 1 ringgit and 19 cents per share. Dividend yield is 922%. Absolute return is 3,312%. So this is Padini. Okay, isn't that cool to get a 3,000% in 20 years time? All right, buy and hold only 1 year make about 17%. In 2008, of course, it crashed 48%. But does it go up? Yes, it still go up. Okay. In 2020, also crashed 45%. Now Padini is 2 over ringgit. Yeah. So will it go up in the long run? I would think very likely it will go up. Case study, Topglov. All right. Well, this stock has got a lot of investors to be to go crazy. Okay. Now, if you buy in January 2001, of course, it got listed. It didn't get listed in 2000. It got listed in 2001 March. Okay, it's of course the listing price is not 1.4 cent. Of course, after many bonus issues, so it is adjusted for bonus issue. So now so this one I can't get exactly 20 years because it did not start in January 2000. It started in March 2001. So this is probably 19 years and a half. Okay, 19 and a half years. From 1.4 cent to 8 ringgit cents. Okay, so the total capital gain is 62,000%. Okay, compound annual growth rate is 38% a year. Okay, cool or not cool? So total dividend you receive 33 times. Okay, dividend year alone is 1,732%. So absolute return is 64,000. Okay, 64,000 over a period of 19 and a half years. So right now, Topglov is trading at 8 ringgit 76 cents. Still got chance or not? If you ask me, right, it is a bit tricky because Topglov now is pretty, glove stock is very sensitive and very volatile. If you don't have a heart of steel, better stay away from glove now. But in the long run, if you look at the glove stock like Tenaga and Topglov over the long run, I believe that it will definitely go up in the long run. Okay, if you look at the PE right now, if you analyze the latest quarter of Topglov, if you take in comparison to the share price and the earnings, it is still quite attractive. But people now think that the vaccine will reduce demand, and when the ASP normalize, then probably the share price will tank. But of course, at the price right now, I still feel that you still have should have some room for growth. So should have some room. So of course, this is just my opinion. Of course, I can be wrong, but looking at it, I think Topglov will still have some room to climb. In 2008, crashed 65%, and then in 2020, there's actually no crash. When everybody else crash, right? Topglov actually no crash, and still go even higher. Okay, and right now we are seeing a resurgence of cases in Malaysia. Not because it have always been there in the COVID-19 cases has always been there. In other, like in America, in Europe was getting worse, and then now the US president also got diagnosed with COVID-19. So don't think that this pandemic will go away anytime soon. Of course, let's hope that the vaccine will come up fast enough so that we can have a meaningful recovery. All right. But even though the vaccine has come up, will have come up sooner than we expect, it will still take until 2024 or 2025 until everybody on Earth is fully vaccinated. So I think the demand for glove will not drop so fast, but probably until the extraordinary ASP will still be there until 2021. Now, if you invest in great companies at attractive prices, your risk is very minimal while your potential is very high. So risk comes from not knowing what you are doing. So this is what Warren Buffett said. So if you don't know what you're doing, then you're risky. If you know exactly what you're doing, then it's actually not risky. Okay, if I ask you to drive a Ferrari on the route, is that risky? Or you'll be very risky, right? But if I ask Michael Schumacher, okay, to drive Ferrari, then of course it is not risky, okay, because they are trained. So the same for you. You need to be trained. Now, what is secret number 3? How to achieve 1 million ringgit with just a fraction of your income? Okay, it is achievable. The answer is you must do effective money management. Okay, I'm going to share with you a surefire way to become a millionaire. Okay, now assuming that every year you invest 20% of your salary that grows at a compound annual growth rate 15% a year. So every year you make enough money, you set aside 20% of salary, don't touch, that is for your financial freedom. Okay, you set aside 20% of salary and grow at 15% a year. So let's say you start with 3,000 a month. If you have 3,000 salary a month, then you will have 36,000 in a year. Okay, so you set aside 20%, that means you invest 7,002. Your 7,002, you grow at 15%, right? It's become 8,280. So in year 2, let's say you got good performance in your job. Okay, your boss give you 5% increment. Okay, I'm sure you expect increment, right? So your 36,000 become 37,800 a year. Okay, so you set aside 20%, and then grow at 15%, then you grow at 18,000. Okay, then in 3rd year you become 30,000, 4th year 44,000, in the 13th year it becomes 353,000. Okay, So in the 20th year, it become 1.1 million. Okay, every year just set aside 20% of salary to invest, and every year get 15% return a year. By the end of 20 year, when you invest, you become 1.1 million. By the end of 30 year, you become 5 million. So every one of you can be a millionaire, whether you're young, whether you're still 20 years old or 19 years old. Okay, if you, let's say you go out to work at 22 years old, then by 52 years old you should have about 5.1 million. So that is assuming you follow this very straightforward money management technique. Okay, every year set aside 20%, you cannot touch it. This is for your financial freedom, for your retirement. Okay, and you must grow the portfolio at 15% per annum. But what if you can take a bigger risk and you achieve compound annual growth 20%? Then of course you take 17 years only, which is the starting monthly salary of 3,000. Now of course some of you here who are watching this live could be making more than 3,000 a month. Okay, you could be making 5,000, 8,000, 10,000, or even 15,000 or 20,000 a month. Okay, of course if you're making 20,000 a month, then this is even easier for you to become a millionaire. Okay, now let's talk about portfolio return case study. Now here, let's say we have 3 portfolio here. Portfolio A, every year make 15% return. Portfolio B, every year make 25% return. Last year lose 35%. Portfolio C, every year 100% return, then next year lose 50%, 100% return, lose 50%, 100% return, lose 50%. Can you tell me in the Facebook comment? Tell me, okay, which of the portfolio would be bigger by the end of the 6 years? Which one? Let me take a sip of water. A, B, or C? Now the answer is portfolio A. By the end of 6 years, the portfolio from 100,000 will grow to 231,306 ringgit. Portfolio B from 100,000 will grow to 198,364. Portfolio C, because double a year and drop 50%, double, drop 50%, the actual return is 0%. Okay, so what does it tell you? Portfolio A definitely generate better return. Okay, and because of stability, because portfolio A is consistent, there's no year that it lose money. Portfolio A choose to be safe, choose to don't take excessive risks, just stick to 15% return a year. Every year 15% return. Then by the end of 6 years, they more than double their money. Portfolio B go for maybe growth stock. Okay, growth stock, all growth stock. Okay, 25% rate. But 1 year when when they got the investment wrong, minus 35, then actually they underperform portfolio A. So what is your learning point here? The learning point is definitely diversification, number 1. Okay, number 2, stability always outperform aggressive. Okay, stability, you must go for you must, in anything you do, don't take excessive risk. You just take adequate risk. Okay, we must take risk, but don't take too much risk. Because if you engage in a speculative trading, then you may not be able to outperform. There are people who every month trade. Okay, every month in for 2%. In 1 year they get 20%. But if there's a few months, let's say in 1 year there are 12 months, 9 months make 2%. There are 3 months that lose 2%. Actually, also cancel out only 12% return a year. So you might as well go for stability. Okay, don't have to trade in, trade out, but just go for stability. Okay. Now this is the net worth of Warren Buffett. You see, net worth. You see, Warren value investing always work. So not only has worked for them, it can also work for us. Okay, you see that the net worth will compound to become very high when it's old. So that's why you must be patient. Okay, so why value investing? Number 1, it is the safest way, is the safest strategy ever known to mankind. Okay, on how to give us a return. Okay, safest way, surest way. If you buy into a good company at an undervalued price, if you put over long term, you should be able to make money. If you don't make money, then something is wrong with the strategy. Okay, value investors should make money in the long term, because in the long term, the true value of the company will be reflected on the share price. Okay, so value investing is the surest way to help investors like us to build sustainable wealth. Number two, save time. You don't have to glue your eyes on the screen all the time. Okay, just follow up with the every quarter their financial reports. Okay, time saving. Don't have to trade in, trade out. Don't take so high risk. Number three, give us a peace of mind. Okay, so we can sleep soundly at night without have to worry. Okay, if tomorrow get down, how okay, if you buy into a good company, even though tomorrow get down, you will still be safe, because you know that when you hold it long enough, you should be able to make money, because you already buy a good company below the value, so you should be able to sleep soundly at night. So the surest way to help us build wealth, save a lot of time, and give us a peace of mind. But the last thing we want in investing is to be emotionally stressed about that. So value investing are a bunch of happy people. Okay, in the downtrend, what we can do, we back up the truck. In the downtrend, we also happy, because why? We can buy things on the cheap. It's mega sale everywhere. Okay, what we do in the uptrend we also very happy. Why? Because we can chill and relax and make money. Okay, uptrend we happy, downtrend we happy, sideways are we happy? We also happy, right? Sideways we collect dividends. Okay, sideways collect dividends. So uptrend happy, downtrend happy, sideways we are also happy. Okay, so look at all these world's most successful value investor. Okay, aren't they smiling very, they're green very big, right? Look at Warren Buffett. Okay, almost 90 years old. Charlie Munger, I think he's about 95 years old. Okay, Evan Kang is the longest lived value investor. He passed away at 109 years old. So all of them very happy and live very long. Okay, so if you want to live a long life, right? Don't be too stressed lah. Okay, subscribe to value investing. Okay, live long, live happily ever after. Okay, Warren Buffett every day still drink Coca-Cola and eat McDonald's, still can live until 90 years old. Okay, so you all must practice value investing.